Hey traders, Jason from Leavitt Brothers. I hope you're well. Today I'm going to do an update of my state of the market review. Some of the things I'm looking at are very encouraging. Other things are much less supportive. I'm not going to get into guessing games or debates regarding the economy or the recovery. Instead, I'm just going to stick with the charts. Okay, they'll guide us. We need to trust them. Okay, when casino stocks double or triple at a time when casinos are completely shut down for business, we are reminded to play the price action and not ask why or how something happens. All right, so let's go through this. All right, so here's the S&P Daily. I want to make something clear here. Okay, using history to forecast prices right now is probably not very wise. All right, let me show you an example. Okay, this right here constituted the biggest and fastest bear market in history. Okay, this move here was the biggest 3-day rally in history. And this entire move here, which was 35%, is the biggest bear market bounce in history. Okay, so when so much is happening that has either never happened or has rarely happened, it would not be wise to assign odds to certain price actions or certain price sequences playing out going forward. Okay, what are the chances of a double bottom? I don't know. How far, if there is a double bottom, how far apart will they be? Will the bottoms form? I don't know. How long will it take to get back to all-time highs? I have no idea. Using previous price action to guess what's going to happen forward just isn't wise, because what has happened over the last 2 months has basically never happened before. Okay, so again, if this has never happened before, and this has never happened before, and this kind of a big move has never happened. What never happened before? Like, what makes you think you can guess what's going to happen here or here? I don't actually have any idea. Okay, so if stuff over here has never happened, like, what makes you guess that you could just superimpose today's chart on some chart from 4 decades ago and come up with, like, a 70% chance that something is going to happen? It's not going to happen. Okay, so don't even try. Let's just study the price action. So here is the daily chart. What do we have here? What is the price action? So we have a 1, 2, 3, 4, 5 type of sequence up to a negative divergence with the stochastic cycling down. Okay, that tells us great move, but negative divergence, stochastic cycling down tells us to be a little careful in the near term. Okay, maybe this thing cycles down and goes 0. Maybe we get one of those kisses where it comes down here. What if the stochastic did that and then we get a bounce here at the same time that this cycled down and moved up? Either one is possible. Okay, but all I know is that after such a nice sequence up, negative divergence, stochastic moving down, we should be more careful. We've been long, we've made good money, all that's good, but we're traders. We're not buying, we're not buying and hoping, not buying and holding. We're trading, and there's enough evidence right now that maybe a rest is needed, that we should probably pay attention to those warnings and protect our long positions. Okay, so let's look at some breadth indicators to show what's going on beneath the surface. All right, well, actually, first I have, this is the weekly chart. So first, here's the weekly chart. So we have it's kind of like a broadening pattern. Okay, higher high, lower low. Price is just nearly in the middle of that. Okay, nearly in the middle of the high and the low, a little bit to the high side, but it's basically in the middle. It's in the middle of the 50 and 200 week moving averages. Okay, so I don't think you can have a strong bias here. Huge move down, really encouraging move up, but we're essentially in the middle of the range, and prices are no different than they were, more than 2 years ago, basically the beginning of 2018. Okay, to have a strong bias here, not wise. Big move down, big move up, right in the middle of a lot of different things. So I think we're wise to be neutral here, and not have an extremely strong opinion of what goes on next. Okay, maybe we can move up, maybe we can move down. There doesn't seem to be a ton of momentum on the weekly time frame. All right, so here is S&P 500. We have the 10-day moving average of the 80 line, and we have the cumulative 80 line. So first of all, as far as the cumulative line, it broke down. Typically when the market is trending up, you get higher highs, higher lows. The 80 line trends up, mostly above its 50-day moving average. It crossed down over here, trended down. That coincided with the drop. So during this entire rally up, the 80 line's been moving up, but it had, it struggled over here, and finally we got above it. So this is very encouraging. Okay, if the market could dip down, do some backing and filling, that's fine, and the 80 line could also dips down and does some backing and filling, that'd be perfectly fine, encouraging. As long as it can hold the 50 and bounce off and continue up, the market should be in good shape. But if the 80 line falls below the 50 and you get some sort of rejection like this, then all bets are off. We're probably going to head south. Okay, so how this acts around the 50 is going to be very important. Okay, as far as the 10-day line, you guys know the routine. Typically in an uptrend, you get swinging patterns, swinging movement, mostly above zero. So you get up, down, up, down, up, down, with an occasional move down, which coincides with some sort of temporary rest. Okay, back above, doing well, and then you get a move down, which coincides with a temporary rest. So you just get this rolling action of high price, high and low prints with occasional moves below, which coincide with just temporary rest. It's all fine. But when you get a move down that's like really big, that's going to coincide with a bigger, something that's a lot more than just a rank and file pullback. So the 10-day got above zero. It's been above zero. It's been above zero for 6 weeks or so. It's great. So far so good. Okay, if this comes down to zero and bounces, that would be great. Even if it fell below zero, as long as it didn't fall too much, that'd be fine too. If it fell down here and actually stayed down here for a week or two and then moved back up, that'd be fine too. Okay, all those scenarios are fine. The only one we don't want to see is an actual big move down, below where I have the bottom of the boxes here. Okay, oscillations are fine. They suggest an uptrend and temporary rest within an uptrend, but you don't want big moves down. Okay, less encouraging here is the chart up top has the 50. It's the 50-day moving average of the 80 line. Okay, what you get is divergences help us tell us when tops are in the process of forming. So you get lower highs there. Market moves up, lower highs. Market moves up, down. Market moves up, lower highs. Market moves up, basically like flat. Okay, so the 50-day moving average of the 80 line tells us, it takes a couple months to form, but it tells us that a top is in the process of forming. So what is not very encouraging right now compared to the past is that in the end of 2018, beginning of 2019, we had a very quick recovery, a pause here at zero, and then a continuation while the market rallied hard off its low. What we've gotten today is we've gotten a really hard rally off its low, but the 50-day moving average hasn't moved up much. Okay, it's maybe recovered half. So we have a big void space here. Okay, and that's not very encouraging. Okay, and it's definitely an eyesore. It's definitely something we have to pay attention to, and it warns us that despite this big move, the 80 line is not strong enough to really support a continuation. Now, this is the 50-day 80 line, 50-day MA of the AD line, which means 50 days is about 2.5 months. So that takes us there's 1 month, there's 2 months, 2.5 months basically takes us back to the high. So we're going to start getting some prints over here, and we're going to start losing some of the higher prints from back here. So we need improvement here. We need this thing to go up. We need it to suggest that things are going well beneath the surface. Otherwise, the market's just simply not going to go up very much further or for very much longer. All right, here is the Nasdaq versus, it's the same chart as the one we just did, except with the Nasdaq 80 volume line instead of the 80 line. Okay, I'm going to go through this a little bit quicker. So the 80 volume line down below is doing fantastic. It dropped below its 50. did a little double bottom, got above its 50, and now obviously at a new high. Okay, so even though the index itself is not at a new high, the 80 volume line is, which is great. The 10-day of the 80 volume line, little divergence here, not concerned. Divergences that take place at a high level are less potent than the ones that take place at a low level. So all I know is that we've had some really high prints over here, and as long as we can continue to get prints either up here or with minor dips below, market will be in good shape. Okay, so that the difference between the Nasdaq and the NYSE is pretty stark. Nasdaq carrying the load. It's assuming much of the responsibility for the gains. NYSE lagging some. Okay, here is the Nasdaq 80 volume line with the 50 and 200-day moving average. Very similar to the chart that I showed you just a second ago. We have, market moves up. The blue line is the 50-day moving average of the 80 volume line. Divergence there. Market moves up. Divergence. Market moves up. Little divergence there. Okay, so divergences help us. Okay, what's encouraging here is that off the 2019 bottom, market rallied. We got a nice move here in the 50-day moving average, paused here, and then moved up. We're getting the same thing here. Little double bottom here, moved up, pause here, and now it just moved up. Okay, so the Nasdaq is doing well. Okay, this move here is fully supported over here by the 80 volume line. Okay, it looks great. Not so great at the NYSE, but looks good at the Nasdaq. All right, busy chart here. Here is the SP 500. This is the percentage of S&P stocks above their 20-day moving average, above their 50-day moving average, and above their 200-day moving average. Okay, when the market is healthy, you get steady prints above 50%. Dips, here coincide with just moves below 50%. But as long as they dip below 50%, they hang out there for a week, 2 weeks, 3 weeks, 4 weeks, and then they recover. The dips aren't that bad. Okay, this is a normal sequence for a healthy market. When you get a bigger move down, which is what we got here, that coincides with a bigger move down with the market. So what we have here is we have a nice rally. We have a move above 50%, a divergence here, which isn't very meaningful to me because it takes place at a high level, but this is good. Number of stocks at the SP 500 above their 20-day moving average has been above 50% for, 4 weeks or so. That looks great. As long as it stays up there, market will be supported. Even if it dips back down, as long as it doesn't dip too low, uptrend will be supported. Looking at the 50, it's much less encouraging because all we got is a move up and then an immediate move down, which is more like something like what happened over here at the end of 2018, where it got above 50% and then immediately lost it. And actually, it's 55% with the 50, but you get the point. A little drop here, fine, but we don't want to see too much damage here, okay? Because this lagged a little bit, and then it got above, and then immediately lost it, and that's not very encouraging. We want to see this thing firm up and get back above 55%. With the 200-day line, it's also not encouraging because we have a gap here. Okay, if we study over here, market got above 50% here, which coincides if I come up here before the S&P had actually even gotten above its own 50. Okay, so it's almost like beneath the surface stocks were leading and then the index got above. So S&P got close to its 200 over here, but there's still a huge gap here. I mean, there's only 25% of stocks that are above this moving average, which is not very encouraging. This needs to improve. Okay, if the market moves up from here, we need more stocks to trade above the 200-day moving average, or else the S&P itself over here is not going to get above its moving average. So progress being made, but given the huge gain off the low, given the fact that we're been trending up, given the fact that we're above the 50-day moving average, we need more support there, and we need more support here. All right, here is the Nasdaq. Similar chart to the last one. We have the Nasdaq versus the number of Nasdaq 100 stocks above their 50-day moving average and Nasdaq 100 stocks above their 200-day moving average. Okay, what we get here is divergences tell us tops are forming. Okay, so we have Nasdaq higher high, but less stocks above their 50. Nasdaq higher high, less stocks above their 50. Nasdaq higher high, less stocks above their 50. Okay, same thing here. Okay, you typically get, you get a high print. Okay, and then that kind of achieves like escape velocity, and then the market can carry forward for another 4, 5, 6 weeks. Deterioration takes place under the hood, and then you get a top. Okay, so, but that first top is really important. It helps the stock gain, it helps the market gain some momentum, and then it could typically carry forward. So this print up here is really, really encouraging. It's very good. So what I'm looking for going forward is, even if we do some backing and filling, this print here should be high enough to propel momentum forward. And then we'll just have to look into the future. If we get a higher high, but this over here drifts down, then we're probably going to get another top. That's something to look out for. But overall, this is really good. Okay, I'm not predicting this. I'm just laying it out as a possibility. Overall, this is really good. We got a high print here, tends to continue. The high print here coincided with this high. We pulled back, but then we continued on. The high print here coincided with here, and then the market continued on. High prints here coincided there, the market continued on. Every time we got a high print, we got a high print here, okay, led to a flat period, and then we continued on. High prints tend to lead to further high prints later on. All right, so Nasdaq, good shape. All right, last chart. This is the SP 500 versus the new highs at the NYSE and new lows. So to look at the 2018, 2019 bottom, when the market first moves off of a low, you don't expect new highs to expand, but a month later they start to expand, and you can see that I went up here, over here. So looking at today, they didn't similar action here. Okay, they trended up above their 10 moving average, but just last Friday, instead of like moving up, instead of doing this, which is what happened 2 years ago or a year and a half ago, they drop back down. So it's something to watch out for, is that like at first new highs are not going to expand, but then eventually they need to expand, and they haven't done that yet. So it's something to look out for. At the very least, okay, new lows have not expanded. Okay, so if this drops back here, it's not going to go below zero, obviously. But if this drops back here and new lows start to tick up, that would be a concern. But as long as new lows stay low, we should be all right. But eventually, we're going to need this to move up in order to confirm any type of price action. All right. So the first move off the low, I'm encouraged. Okay, there's a big move. The bounce, the bounce off the low is 35%. The bulls were strong; they're in control, but the 80 line at the NYSE is lagging, and new highs haven't moved up much. Overall, the internals tell us the market has pretty good potential, but a big test, in my opinion, is right in front of us. Okay, the market can do some backing and filling right now. Okay, that's fine, but I wouldn't want to see too much damage to the price chart, and I wouldn't want to see the internals deteriorate too much. Okay, we've had some fantastic trades lately. Last week I sent out a link to our email list with many solid setups that did great. But now it's time to step back and allow the market to kind of show us how strong it really is. All right, thanks for listening. Sorry this got kind of long. It's getting towards 19 minutes. You could follow my YouTube channel by clicking the subscribe button here at YouTube. And again, while you're sitting at home, check out my mini masterclass in trading. It's free. Okay, there's a link below. All right, see you next time.